I've done thousands and thousands of first meetings and listened to thousands of first pitches from entrepreneurs over the last 10 years. I probably meet with about 500 startups every year. Did it myself. I pitched hundreds and hundreds of people for money myself. All of these thoughts come from what goes through my brain as an investor now as I'm going through those first 15 minutes. And what are the things that I see that make me say, you know what, this founder's probably not a fit for us, or we should have another conversation. This one's actually pretty interesting. And we should dig deeper into it. Hey everyone, Brett here. We're starting a new series called The Decision Curve. What we wanted to do is help you get inside an investor's mind as far as when you're pitching an investor for that first time, second time, third time, what's actually going through their brain? What are they thinking about? What are they evaluating? What are they looking for? As always, our goal at Brett's Brain is to help entrepreneurs succeed. It's what we started this for, is we wanted to share tips and tricks and just things that we've learned through working with investors, working with entrepreneurs. I started several companies myself. I raised venture capital. I sold a couple. I ran one into a brick wall. That's the whole purpose of Brett's Brain, is to try and help entrepreneurs succeed. And so hopefully this decision curve is another step in that. And we really can help you improve your odds at building really strong relationships with investors, which will then lead to raising rounds of venture capital and bringing in those partners that you really want to work with to build your startups. So the first portion of the decision curve that we're going to go through is that first 15-minute meeting. There's really three key things that we're looking for in those first 15 minutes, or three pillars, if you will, that can really help you move on to the next round or give you a chance at raising a round of capital. And it's not what you might suspect. The first pillar that we think about, or that always crosses my mind in that first 15 minutes and should always come through, but doesn't always, is conviction. How much do you believe in your business? How much do you believe in the thing that you're building? Have you been thinking about this? Have you experienced the pain point? Do you know it needs to be solved? And do you know that if it is solved, it's a huge opportunity? Are you the founder to solve it, and why? So think about all those things from a conviction space. And there's a couple of real red flags that can pop up when we start talking about conviction. It's your super early stage, and already in your pitch deck, you have a slide that talks about how you're going to exit in 3 years. It might seem counterintuitive, but I actually don't like it when founders talk about exiting quickly or exiting at all in a pitch. I don't really worry about that. If you build a big giant company that's worth a lot of money, our return is going to be there. Obviously, you have to sell the thing or IPO eventually, but we actually don't want companies to flip quickly, to sell quickly. That's not a great sign. That's not a sign that you have something big that you really are going to stick with it and go after it for a long period of time. So beware that red flag. Beware the we're going to sell quickly red flag. A second piece on the conviction side is if a founder's not full-time on the company or the startup. I realize that people come from different backgrounds and have different financial means, but the reality is if you walk into a pitch and you're not full-time and you're pitching an investor, it sends a signal, and it's not a positive one. Even if you say something like, once we raise this round of capital, I'm going to go full-time onto it. Or if one of the co-founders isn't full-time, if there's one co-founder that's full-time and a second that's not, that also sends a signal. And it's actually really difficult to overcome that for a seed stage investor. You might be able to pitch angels and get a little bit further along, but you might not be ready for institutional capital if you're not yet full-time on your business, because it shows a lack of conviction. If you really believe this thing's gonna be worth $1 billion one day, why wouldn't you go full-time on it? You do everything you can to make it happen, to be focused only on that. Second piece is that sometimes it might seem counterintuitive as well, is founders that just keep talking and talking and talking during a pitch, and they don't leave room for any questions. To me, it's over talking. You're trying to oversell. You're telling me little thing about your business in that first 15 minutes, and you're not letting somebody ask questions. The best founders that have the most conviction aren't afraid of hard questions. They don't push back on hard questions. They welcome questions. So they'll give you the kind of high level overview, tell you why they're passionate about it, why they're building this thing, why they're going to take over the world. But then they leave plenty of time for questions because they want to dive in. They want to make it almost like a working session rather than a let me tell you how awesome I am session. So those are a couple of different things to think about in those first 15 minutes of how you can establish yourself as somebody that's really, really convicted about the thing that you're building and why you're going to take over the world. To give you a very real example, I didn't have strong conviction or passion behind my first company. And it was a good idea, but it wasn't something that I really cared about. We sold uniforms. We were early on in e-commerce days, and we were making it easier for people that needed medical scrubs, restaurant apparel, things like that, to get them digitally. I saw a market opportunity, and we built a company around the market opportunity. But as soon as somebody came and offered us any amount of meaningful money, I sold it. And that's great for me as an individual founder, but there was no way I could have or should have raised venture capital against that company because I wasn't in it to win it. I wasn't in it to take over the world. I just didn't have like that much conviction around the idea, the passion for the idea. I didn't come from the industry. I knew it was a way to make some money, and there was a cool business there, but it wasn't like that big next thing, that venture backable business. And so I would say that in my own experience, just from being on the founder side, that's a really good example of, you could call it conviction or passion for your idea. And I didn't have it in that one. I love entrepreneurship and building something, but for the idea itself, it just wasn't there for me. The second pillar that really can help a founder move through the decision process smoothly, and especially those first 15 minutes of an investor meeting, is demonstrating that you're coachable. What coachability to me is, it's people that are willing to go out and collect data points. They're willing to go out and listen to people and actively listen, not just having information go in one ear and out the other ear. And that's the difference. You collect all those data points as a founder, and then you still make your own strong decision and move forward with it. And it actually is pretty obvious when you're meeting with somebody for a first time and you're getting pitched by somebody who's coachable and who's kind of going through the motions with you, and you give them a piece of feedback and you can kind of tell it's just, oh, that wasn't a very good piece of feedback, or what do you know? You don't know anything about this. Versus the founders that hear a piece of feedback and they dig in with you. And that's how you can kind of tell. So if somebody asks you a question, even if you think it's mundane, don't brush it off. Dig into it. Say, ask for clarification. Why do you think that? Well, here's how we're thinking about it. Don't be afraid to push back. But taking that piece of feedback that you just got as a founder and digging deeper and understanding that maybe this investor actually does know something. Maybe they see hundreds of companies in my space and there's a nugget I can take out of it and use it to make a better decision on my own in the future. But it does become a real red flag when it's kind of obvious. You give a piece of feedback and they just brush over it and move on to the next topic. A couple of other red flags where, this pops up is founders just plow through an entire 20-minute pitch session without having any questions available. You just, everything's right, everything's perfect. Another real red flag for something that is not super coachable is name dropping, right? And we find that those two things correlate. If you're out there name dropping, then you're trying to demonstrate your expertise and how many people you have around you, but it tends to actually be the opposite. If you feel the need to name drop, you might not actually be willing to listen to people too frequently. There's a great founder whose board I'm on right now, and one of the things that they do is they come to every single meeting that we do, and we meet monthly, and then we meet ad hoc even more frequently than that. They come really well prepared. They come with thoughtful questions. They quickly can understand where the people around them can help them, what they're good at. So are you good at fundraising advice? Are you good at HR and helping with people and people issues? This founder comes to me all the time with, here's the 2 agenda items I have for our 30-minute meeting. Here's the stuff that I really want to dig deep in with you. And, it took a little while for us to get to making sure that they knew exactly, where I could be most helpful to them. But it's that preparedness up front. It's asking for help with real problems. So it's transparency on, I have an issue with this thing. I want your feedback on it. It's not coming and saying I have everything figured out. It's coming and saying I have some stuff that I don't know. And it doesn't mean that person always listens to what I say or does what I say, but they always do listen. They don't always do what I say, but they always do listen. They collect those data points. They're really, really great at being coached because they know exactly who they should go to for which issues they're solving. And that's a great example of a founder that to me is an exceptional CEO, but also is great to work with, fun to work with. Like if they ever ask us for help, we do it immediately because we know they're going to execute against whatever we just helped them with. All right. The third pillar, the third thing that really can come through as we're going through the decision process in that first 15 minutes of a meeting with the founder, within the first 15 minutes, you can often tell if a founder is appropriately confident or over the line arrogant. As an entrepreneur, it's really, really vital to have an outsized amount of confidence because you get told no so many times in your journey. You get told no hundreds and hundreds of times for every one time you get told yes. And if you don't have confidence in what you're building, in yourself, in your abilities, you're not going to continue on that journey. You're going to stop. You're going to quit because you just get beaten down so much and nobody likes that. Now, you can step over the line and move into arrogance. And it's a fine line. I know because I've fallen into that trap myself as a founder. But how I define the difference between confidence and arrogance, when you're confident, you're still willing to go out and collect data points. Once you're arrogant, you don't waste your time or even think about, maybe somebody else can help me with this decision. I don't need to collect additional data points. I know exactly what I'm doing, and no matter what anybody says, it can never change my mind. I'm right, I'm right, I'm right. And you just keep plowing forward without being willing to collect those data points that can help you make better decisions, help you move forward in a healthier, better way. And it's a real struggle, and it is a real fine line that you have to walk in. If you've had a couple of great decisions and you've had some success in your journey, you can easily fall over that line. That's what happened to me, where there was moments in time where, I'd had some success as an entrepreneur, and I did it with having great people around me that were able to get to me. And then in my last company, we had a real need to hire a CTO. And we hired somebody. I felt the need we just raised some venture capital. I needed to put butts in a seat. I needed to get somebody in that role, and was having a hard time filling it. And we had some good candidates, but the candidate that we ended up hiring was great on paper for the skill set we needed, but didn't fit our company culturally. And I knew it was going to be an issue, but I was really arrogant in the fact that I could change him, or I was a strong enough leader that I could keep the company on track even with one person that, wasn't a great cultural fit and might throw other people off. I'm strong enough. I don't need the extra help. I'm strong enough. I can change him. Well, I was wrong. And when you're a small team, when you go from 9 to 10 employees, you change your company culture by 10%. If you're going from 3 to 4, you're changing it by 25%, right? Like, it's crazy. It's different. And one bad hire or one bad mistake that you make because you're arrogant can absolutely kill your company. And that was a example of how arrogance can kill your company, and why it's so important, why it's something that we think about as we're evaluating a founder. And it's something that often can come through in those first 15 minutes based on a couple of those things I said, name dropping, not looking for a salute, not looking for help, plowing through a pitch. And there's a couple of things that have come up in each one of our sections that are obvious red flags for an investor. So those are the 3 things that are going through my brain in the first 15 minutes of a meeting with an entrepreneur. It's the confidence versus arrogance, it's the coachability, it's the conviction. Those are often the 3 things that will enable you to move to a second meeting, or even have the attention of that investor for the back half of a meeting versus, you're sitting there 7 minutes in, I'm definitely not investing in this company, which happens more often than not. Within 5 to 10 minutes, I know I'm not going to invest in this company. You'd be surprised at how quickly we can make decisions, and it's based on all the things we just talked about. So just a couple other quick pros and cons, green flags, red flags, if you will, that we see or look for that often come out in the first 15 minutes. One is you show up prepared. You've done research on the fund. You've done research on the investor. Some of the other investments that we've made. You talk about a blog post that we wrote, whatever, right? You come prepared. The types of things that as investors, we're really excited about. You can demonstrate that through positioning your company that way, or even just mentioning that you did it, showing up on time. Sounds simple. A lot of founders are late. Show up on time. I understand that you might need to reschedule a meeting every now and then, but if you reschedule a meeting 2 times in a row or 3 times in a row with an investor, you're probably going to be dead at the start. And so just be mindful of time and rescheduling, because it shows where your priorities are. And if your priority isn't fundraising, then don't do it. Or if obviously I'm not that important of an investor to you, why do you even want to talk to me? And those are the kinds of things that come through. You got to know your numbers early on. So you don't necessarily need to plow into them in the first meeting, but if I ask you a question early on about, hey, what's your CAC, or what 3 KPIs do you have right now? Be ready with that stuff. Know it off the top of your head. Don't ask, well, I need to check with my CFO on that one. Customize your pitch. And this ties into the first thing I said, we're being prepared, right? If you've done research on a fund and an investor, you should be able to tailor your pitch to that investor. And if you do that, man, it shows how thoughtful of an entrepreneur you are. And it really demonstrates that you're a good salesperson and that you have the potential to build a big company. And the final thing is tying into that conviction. And I talked a little bit about this on the passion side with my first startup, is why are you passionate about this idea? Why are you going to stick with it even if somebody offers you, life-changing money early on, but you want to build $1 billion business? Where does that passion come from? Where was it built from? And why do you have it? Having that founder story that is impactful and meaningful can really be a difference maker in that first 15 minutes. Oftentimes, the first 7-8 minutes of a meeting is me hearing the founder story. And those are the best meetings many times, because it draws you in. You want to be a part of it as an investor. Now, on the flip side, there's a couple of things that are real red flags. We've touched on a few of them over the last few minutes of video, but being late, right? Obviously, if you're not on time, you're late. Why not show up a minute early if you can? Like, don't show up late. It's just really important to show that you're ready to go. I hate name dropping. Always have, always will. I think it is demonstrative of many negative traits and many negative things. Don't oversell. Every single startup on the planet has red flags and have things that you don't know. If you come off in the first 15 minutes as you have everything figured out and you're a pre-seed or seed stage startup, I'm going to know that you're full of crap. It's just impossible. There's always red flags around startups. And the way you can demonstrate that you're coachable, which is one of the important things, is you say, hey, I've got these 3 things figured out, but this one's hard. I could use some help on this one thing. And so don't pretend like it's all perfect and that you have everything figured out. And that's overselling. That's how I think about overselling. I hate it when I hear a founder say, we're the only one in the world doing it. We're the only one in the world, fill in the blank. That is complete BS. If you have a unique idea, it's a stupid idea. Flat out. Everybody's got competitors. Everybody's got people figuring out the way to save problems, maybe in different ways, but you always have competition. You'd be surprised at how many times I've been pitched an idea and the founder tells me they're the only one doing it. And we have a portfolio company that's tackling the same problem or doing something really similar. Not only did you not do your research or come prepared, because you obviously would have found that startup, but then you made a claim that I can immediately dismiss, and you're dead in the water as soon as that happens. So it's very, very, I've never been pitched a company where it was the only time I've ever seen somebody tackling that specific problem. Dismissing feedback immediately. Hey, here's a piece of feedback for you. Oh, no, that's not important. If that's your immediate response, like, big red flag. And so these are just a couple of the small signals that, in that first 15 minutes can immediately take you out of the running for being able to get a check from any investor, not just us. So be mindful of the negatives and really take time and be prepared so you can come in and demonstrate how good of a founder you actually are. Just keep in mind how important first impressions are. There's all kinds of famous sayings about first impressions. And that's really true in the investment world also. In those first 5, 10, 15 minutes of a meeting, you can make or break your investment. I have committed to invest in startups in a first meeting. That doesn't happen nearly as often as within first 5 minutes, I know I'm not going to invest. And it's not because of the idea. It's not because of the traction, because I usually know those things prior to meeting with you. It's because the way of the founder presents themselves in those first, that first handful of minutes or that first short time that they have with you. And so you can really, really excel and practice and get good at that. And if you do, you're going to really improve your odds at raising the round of capital that will help your business succeed.